Hello, everyone. Glad to be talking to you again about That's Our Two Satoshis, Arca's crypto market recap. A lot going on this week in the market, not just in terms of prices, but a lot of the news flow as well. We'll do our best here to recap some of the things that are on our minds that we're talking about that are affecting the digital assets market. And as always, if you have comments, please go ahead and enter them while we're talking. To start off, quite a week for Bitcoin. Bitcoin was up 13% week over week, Sunday to Sunday, and a pretty big outperformance versus most of the other sectors. We've been talking most of the year about how Bitcoin has underperformed the rest of the digital asset sectors. Almost up until 2 weeks ago, Bitcoin was, I think, the fifth or sixth worst digital asset of our coverage group. So a pretty stark rebound here in the beginning of October. What's interesting about this is, it's really been driven by real expectations and real news flow. A lot of the time, what we see is Bitcoin will start to move for a variety of different reasons. And then people like to point out a narrative after the fact, right? It's Bitcoin went up, therefore it must have been for this reason. This last couple weeks here, it's really been the opposite, which is there's been some real events that I think are shaping the price of Bitcoin and the additional inflows that we're seeing. So first and foremost, you're seeing it across the CME. The CME is the regulated futures exchange, and you're seeing a huge influx of money coming into the CME Bitcoin market. You're seeing it in terms of the shape of the curve. What you're seeing is a steepening of the curve where spot Bitcoin is now on an annualized basis 15% below where 3-month Bitcoin futures are. And the reason for this is the market is really expecting a Bitcoin futures ETF to be approved in some of these October meetings. So in the next few weeks here, we have from October 18th to October 31st, there are 5 different Bitcoin ETF futures strategies that are up for approval from the SEC. And it's interesting that the market has almost put 100% probability that these are actually going to get approved. Now, we at Arca are not feeling nearly as confident as the rest of the market is on this. Our own experience with the regulators suggests that there's very low likelihood of this getting approved here on the first shot. But between comments that Gensler has made publicly, as well as the timing of these applications, as well as the interest that we're seeing across the CME curve, the market is certainly pricing in a high probability that this is going to get approved. Secondly, is on top of the ETF speculation, we start to see a real breakdown finally of Bitcoin versus equity. So we've talked about in the past how Bitcoin has really turned into almost like a levered VIX for specifically traditional finance folks. Oftentimes, you have a lot of news that happens when markets are closed, and if you want to express a move broadly across the market, you'll use whatever instruments you have. You might use equity futures like the SPOOs. You might use the VIX. Well, Bitcoin is really better than both of them, right? It's a 24/7 incredibly liquid instrument that was acting as a risk-on proxy for most of the year. Well, that correlation finally broke down over the last couple of weeks here. And I think on top of ETF speculation, part of it was because of how we had a several unrelated instances of centralized systems and institutions falling all at once, from Facebook and Instagram and WhatsApp all going down at the same time, to a lot of public fighting between the US and China, to even Senator Warren calling for a Fed investigation by the SEC due to all the insider trading allegations against 2 Fed governors who have subsequently stepped down. These are centralized failures, and that's really what Bitcoin and decentralization was built upon. So when you look at, and not to mention the debt ceiling debacle in Congress, another form of centralized failure in our own government. So when you put those two things together, the anticipation of an ETF combined with these centralized failures abroad, really sent shockwaves into the Bitcoin market. And that's why we're sitting here on October 11th with Bitcoin up over 30% for the month already, compared to most other digital assets, which are anywhere from flat to maybe up 5 to 10%. So pretty big dichotomy here between Bitcoin and the rest of the digital asset market, and something which we haven't really seen much of the year at all. Away from Bitcoin, I think the other piece of news that has been driving markets is, again, more FUD on Tether. And we've been pretty outspoken about this multiple times. We saw the Bloomberg article out last week, which was supposed to be an expose on Tether and all of their holdings and all of their business partnerships. From our standpoint, we didn't read or see anything new in what we read. I thought it was an interesting article. For those who haven't seen it, it certainly was um, uh, humorous and well written, but there really wasn't anything new in there. In fact, one of our dealer friends at Genesis actually joked that you can carbon date exactly when people get into the digital asset industry based on how much they care about Tether. Meaning, everybody when they first comes into this asset class is totally scared of Tether and assumes the worst, and then over time you realize it may be unregulated. You may not have all the answers, but it serves its purpose and it's fine. What I think is most interesting about what people are concerned about with Tether is that um, i- Tether definitely has assets backing it. There's no question it has assets. The question is simply, what are those assets worth, and will they hold up in any sort of a stress test environment? And from my standpoint, having been a fixed income investor and a credit investor forever, is you have to understand that when you invest in a variety of different assets, whether it's U.S. Treasuries or whether it's holding it in cash in a bank or whether it's commercial paper in China, you're never fully eliminating risk. All you're doing is transferring risk. So there's no question that if you are a trader or an investor who is using Tether, you are making a conscious decision that you are willing to accept those higher risks. In some cases, you might find the utility of Tether and the flexibility that is worth it to you to potentially take a 5 or 10% drawdown if the assets are not completely there one day if there's a run on the bank. But you're doing that because your alternative is to trust your local government. And a lot of people across the world would rather take the risk of a centralized company like Bitfinex and their Tether holdings than you would your own local government. So, in my opinion, you absolutely would have to have a very forced bank run on Tether to ever get to a point where you say, you know what, the assets are just not worth what they say they are. Until then, it's really just a faith system, no different than anything else. You have faith in your government, you have faith in your banks, you have faith in a lot of different things, and until there's an actual bank run of any meaningful capacity, I don't think there's going to be any issues with Tether. And I think a lot of these things that are being drummed up are baseless, especially compared to other instruments which have very similar holdings. What I thought was probably most funny about the Bloomberg article, though, was this quote, which the author wrote: "Traders send billions of perfectly good U.S. dollars to the Inspector Gadget co-creators Bohemian Bank in exchange for digital tokens conjured by the Mighty Ducks guy and run by executives who are targets of a U.S. criminal investigation." And I thought that was funny, not because of the Mighty Ducks reference or because of the Inspector Gadget reference, but because it started by saying they're willing to send perfectly good U.S. dollars. And what is a perfectly good U.S. dollar, right? We're sitting here in an environment right now where the U.S. may potentially default on its debt due to the ineptitude of Congress and our central bankers. And the best solution being kicked around right now is to print $1 trillion coin out of thin air. So with that backdrop, it's ironic that the article is focused on the flaws of Tether instead of pointing out the flaws of the U.S. dollar. And lastly, away from Bitcoin, away from Tether, in terms of thinking about what is really driving markets right now, what are people interested in? I think you have to look at the airdrops and the reward system that are being put in place that are basically forming a bond between company and customer. If you go back to even the beginning of the year, we put out our annual predictions piece every year. And one of the themes that we were highlighting at Arca was how rewards were really going to shape the growth of digital asset. This idea of uh, capital formation on behalf of a company, but then bootstrapping your customer growth through rewards and through incentives. Um, Early on in the airdrop phases, things like Stellar and others, it didn't work, right? You're just sort of giving money away for no reason. But what we've learned over the last few months is how to better structure these rewards to really tie usage and customer growth and incentives to the platform. And if you look at what's really worked, you have Axie Infinity. Everyone's heard of Axie Infinity at this point, but they just came out in the last week and released a staking where you're going to get up to, I think it's 140% APR right now if you stake your Axies. But more importantly, they just airdropped 2 million Axie tokens in the first month to anyone who had played the game or used the game, with another 800,000 being retroactively airdropped to early adopters at a later time. So that's about an increase in 4.5% of the total supply of Axie directly into the hands of the people who made Axie Infinity work. So I think it's not coincidence at all that the Axie token is up 20,000% this year, because their customer retention rates are off the charts and Axie is rewarding its users. Similarly, we saw the same thing with DYDX. They did a retroactive airdrop, airdropping about 7.5% of the total tokens to their customers. Same thing. This is a creating customer stickiness where DYDX in the last month, on one day, I think it was on September 26th, their volumes eclipsed that of Coinbase in a single day. So, even though those aren't apples to apples comparisons, since DYDX is just derivatives and Coinbase is spot, the point is the same, which is DYDX doing a retroactive airdrop and incentivizing the people who made their company what it is, or their project what it is really having long-lasting effects. And finally, you can look at Terra Luna as well. Luna just released a tweet the other day talking about all the different airdrops that are coming. If you are a Luna stake, if you're a Luna holder, all the different projects that are about to be built on Terra Luna, and that you're going to get airdropped a variety of these different tokens. And again, all these things have the same thing in common, right? They have customer stickiness, they have a token that's going up, and they have loyalty. So I think airdrops are going to be a huge driver in the future. And look, there's been some kinks to work out. Anybody who saw what happened to Ribbon Finance last week knows that these things aren't perfect, but they do accomplish something incredibly important, which is customer acquisition, customer retention, customer loyalty. And I think that's a theme that we're going to see playing out for the next year plus. So that's it. That's what we think are driving markets this week. Look forward to feedback from everybody. Thanks, everyone.